and welcome to Dukascopy TV. Today we'll be exploring US fixed income markets, and joining me to discuss is fund manager at E.I Sturdza, Eric Vanraes. Welcome, Eric.
Thank you, Sinead.
So globally, we have a very strong conviction towards the US market, but this view is not shared in the consensus. So why is this?
Because in the markets, you have two different views. First, the macroeconomic view shared by many economists, because the US economy is doing better. Everybody agrees that the unemployment rate is between 5.5% and 5.7%, so it's improving. Growth is improving as well, somewhere above 3%. And even if there are differences inside the committee, the consensus is betting on the first rate hike of the Federal Reserve somewhere in June or before June. So the economists think that the economy is improving and the central bank will start to raise the rates. So normally it's not time to become bullish on bonds, and you should not buy bonds. But my view is that this academic view is now led by another parameter, which is liquidity, because there are so many billions and billions of dollars of liquidity around the world, and investment managers are sometimes obliged to buy bonds, because individuals, of course, when they have the choice now between bonds and equities, most of them buy equities. But individuals, it's a drop of water in the ocean, because the main players in the fixed income market are central banks, insurance companies, pension funds, and these guys, even if they don't want to buy bonds, they are obliged by regulations or by different procedures, guidelines, they are obliged to buy bonds. And the problem is that now, all around the world, bonds are very expensive and yields are close to zero or even below zero.
Is there a risk that US Treasury yields will fall dramatically and the risk of deflation spread into the US?
Yes, there is a risk of deflation in the US because there is a risk of deflation in Europe. And many investors in US and maybe some members of the Federal Reserve are afraid that the possible deflation in Europe can spread into the US. That's maybe a reason why the Fed did not react, because the Fed said that they will apply a zero-rate policy for a considerable period of time, and now they removed the sentence considerable period of time, but they said we will be patient. The question is, why should they be patient with growth, with a falling unemployment rate? So if they are still patient, it means that there is another parameter which is frightening. It's inflation, which is decreasing, and when inflation decreases to zero and after goes to negative territory, it's a fear of deflation with low oil prices, low commodity prices, everything. So there is a risk of deflation in the US. And I wanted to add that we are fund managers, not economists. So my problem is not to know if there will be deflation in the US. Finally, it's not very important. My view is that I'm a fund manager, I must manage my fund, and I must deliver performance for my clients. So my problem is not to know if there will be the deflation, but if markets will think that there will be a deflation and will behave in the sense of deflation. After deflation, maybe there will not be any deflation in the US, but if during a 6-month period, markets will play the deflation, even if deflation does not happen, my role is to manage my fund in function of these fears of deflation.
So you've touched on Europe a bit briefly there, so let's look over there. So do you think quantitative easing in Europe and Japan will affect the US?
Yes, exactly. That's the problem of liquidity. The quantitative easing in the US disappeared at the end of the year to 2014. but it has been replaced by the European QE that will start in March, and the Japanese quantitative easing, which is huge. It's almost 50% of the Japanese GDP, so it's amazing. And the Japanese QE itself should be the parameter that could lead to zero rates around the world, because the Japanese are forced to buy bonds almost everywhere. But you have also the European QE. And that's a good point in order to favor US bonds. For example, you are a European and you want to buy a 10-year yield bond. You have the choice between a German bond at 0.35% and the 10-year US Treasury at 2% in dollars. So if you bet that dollar will still rise, you keep your bond in dollar at 2%. It's better than 0.35. And if you are cautious, or if you are obliged by your regulation to be in euro, you hedge the dollar against the euro. You give up something like 30 basis points. So you still have a return of 1.7 instead of 0.30. So the trade is easy. You prefer to favor US bonds. And I think that a lot of institutional investors will buy US Treasury because they are so cheap compared to German and to many other bonds. In addition, when I meet many clients, they are reluctant to buy Italian and Spanish bonds at this level of yield, because they say, okay, we understand, we are not stupid. We understand that the yields are so low because they are members of the Eurozone, and Mr. Draghi is shooting with the bazooka, and the QE is huge. Okay, we understand. But we are not prepared to buy BBB bonds, such as the Italians and the Spanish, at a yield lower than the AAA United States of America. So there is also a flight to quality from the peripheral countries of Europe into the US Treasuries.
It's a fascinating subject, and thank you so much for coming in today and speaking with us.
Thank you very much.
That's all from Eric and myself for now. Thanks for tuning in, and remember to keep clicking back to Dukascopy TV. Bye for now.